ahead and get started. I'm going to introduce myself and then our guest speaker for tonight. My name is Dr. George Ozoude. I'm an orthopedic surgeon based out of Houston, Texas. I own a private practice and a real estate syndication company focused on financial freedom for physicians through real asset investing. And I've been running this company for about 3 years now and real excited to start in the real estate space, but then branch out into all real assets, which is a big topic for tonight. I'm very happy to introduce our guest. He's a friend of mine who I've known through different real estate masterminds. I've known him for the past 4 years. It's Dana Samuelson. He's the president of American Gold Exchange. Dana has been active in precious metals markets for 4 to 5 years and has become a true industry leader. Early in his career, he was mentored by industry legend James Blanchard. And with a national reputation for honesty, integrity, and fairness, Dana is a past president of the Professional Numismatists Guild, the leading organization of rare coin dealers in the US. As P&G president in 2016, Dana conceived of and helped to establish the Industry Anti-Counterfeiting Task Force, which today works with the Secret Service and Homeland Security to interdict and seize counterfeit coins and bars coming to the country from Asia. He also recently assisted the CFTC and the SEC with 2 cases involving allegedly fraudulent precious metal sellers. One case is even still pending. The second one recently settled for $50 million in restitution. His company, American Gold Exchange, is a leading national mail order precious metals and vintage pre-1933 U.S. gold coin company operating out of Austin, Texas, with an A+ Better Business Bureau rating and almost perfect Trustpilot consumer reviews. Age celebrates 27 years in business in 2025, with $2 billion in sales and tens of thousands of satisfied clients, including myself. Dana, it's great to welcome you to our monthly podcast and webinar. I will pass it over to you and allow you to share screen, and we'll get going with the presentation.
All right, thank you, George. It's great for me to be here with you. I appreciate it. So I've been in the precious metals arena for 45 years, and for most of my time, gold is just a rock. It doesn't do anything but lay there. So its price is driven by external forces. It happens to be one of the most coveted rocks on the planet. It's malleable, impervious, and scarce, which made it perfect for coinage for a millennial. And then we went on a fiat-based monetary system in 1945 with the dollar backed by gold. We went off that in 1971, and now gold is a true commodity, and it's one of the most trusted assets on the planet because primarily it has no counterparty risk. Its value isn't contingent upon its ability to do anything other than be coveted and be scarce and be valuable. So what I'm going to do is give you a presentation that shows you how over the last 7 or 8 years, multiple cumulative forces have come into bear at the same time to drive the gold price from under $1,400 an ounce to 150% higher to $3,400 an ounce today. For most of my career from 1980 to 2005, 1 or 2 factors would come into the market at a time and then fade, and then a new one would come in. Now we've got 6 or 7 or 8 cumulatively that are all driving gold at the same time, which is why this bull market is pretty powerful. This is my company information, if anyone wants to contact us, and I'll get on with my presentation. So the benefits of owning gold: it has inflation-enhanced purchasing power. That means when inflation comes and erodes the value of your fiat currency and the amount of goods and services that buys, gold tends to hold its purchasing power. It's a counterbalance to traditional assets like stocks and bonds. When stocks and bonds are doing well, gold typically doesn't do well, and vice versa. It's an insurance policy against financial uncertainty or upheaval. It's inversely correlated to the value of the US dollar internationally and interest rates. Most of the gold around the world is bought in dollars but in other currencies, and most of the gold in the world is bought outside of the US. So when the dollar becomes strong, or more valuable against other currencies, it makes gold more expensive in China, in Japan, in Switzerland, in Europe, in Great Britain, dampening down demand. Conversely, when the dollar is weak, gold becomes less expensive in those other currencies, making it more attractive. And against interest rates, gold doesn't offer a yield. So when interest rates tend to be higher, gold doesn't do so well in price because it doesn't provide a yield. And conversely, when yields are low, gold tends to do better because it doesn't have to compete. It's also a hedge against geopolitical risk. And the main attributes are it's immediately liquid, it's truly easily transportable, and it's internationally recognized. And as I said at the top, it has no counterparty risk. So these are the main features and benefits of gold as a portion of your portfolio. And most financial planners these days don't even understand it. Anyone worth their salt would tell you 5 to 10% of assets in gold or other precious metals is a good insurance policy and a hedge, giving you enough of a counterbalance without taking opportunity from other areas where you can earn money, like real estate, which I love as well. So there's been 6 powerful forces driving the bull market since 2019. Fundamentally, gold has been tracking US debt higher. And if we look at a debt chart going back 20 years, our debt doubled from 2005 to 2015, from 7.7 trillion to 18 trillion. And now from 2015 to 2025, it's doubled again to 37 trillion today, actually, which begs the question, where's our debt going to be in 2035? Is it going to be 72 trillion? Hopefully not. But over the same period of time, gold has now multiplied in price over 6 times, actually close to 7 times in value. But it is lumpy for the reasons that I'm going to explain to you, which are the different drivers that come into bear. And for our purposes, I'm going to focus on the period from 2019 until today. So gold is inversely correlated to the dollar and treasury yields. In 2019, the Fed got the federal funds rate all the way up to 2.5% for the first time since 2008. And as we got into 2019, we went into a global economic slowdown. And those treasury yields, which were at about 3.5% for the 10-year treasury, started to roll over. And that was the key that helped gold break out over 1375 for the first time in 6 years, following the great financial crisis, up to 1560. So that was yields falling, gold rising. Then gold went sideways for a period of time, and we got economic instability. COVID hit, economic closures. Gold went through a liquidation event, just like we went through in April when tariff turmoil hit for a few days, when everybody goes to cash for a little while because they don't know what's coming next. And then it buoyed up to about 1750. And then more debt, $6 trillion of new debt to help supplement the economic closures. And gold ran all the way from about 1650 to 2070 in dollars. So let's put a top on that at 2050. And once we got into the summer and fall of 2020 into early 2021, vaccines started to come out. We realized that COVID wasn't going to be the end of the world. Gold settled into about a 1700 to 2050 trading range, and it was leaking, going sideways at about 1700 for the most part when geopolitical instability hit. Russia invaded the Ukraine. Now we've got a war. And gold ran from about 1800 all the way to 2043, a second run at 2050. Geopolitical instability. Now, gold is traditionally a hedge against currency debasement, which is inflation, loss of purchasing power. And here's inflation's ugly head rearing itself up from early 2021 at 2%, on the CPI all the way to 9% in the summer of 2022. And then it started to come off a bit, but that's that huge supply shock inflation surge that we got due to the COVID economic closures. But something unexpected happened with gold. It dropped from about $2,000 an ounce under support at 1,700 all the way down to 1,630 by October of 2022, which no one expected, including myself. But there's a reason for it. The inverse correlation to the dollar and treasury yields, specifically to both of them. The Fed raised rates higher and faster than every other central bank, which led the dollar to a substantial run higher. From early 2022 to October of 2022, the dollar against other currencies went up 18% because the Fed raised rates so hard and fast, which most of you probably remember. For a currency against other currencies, and this is against the euro, the yen, the British pound, and the Swiss franc on the dollar index, this is a moonshot. It is an absolute moonshot. Usually you get 5, maybe 10% moves on a currency. This was an 18% move in 10 months. And that pushed gold down. A strong dollar pushed gold down. Once that peaked in October, other central banks around the world started to play catch up and raise rates as well to combat inflation. And gold got back into range, puffed back up to about 1950. And then just as it was starting to ebb lower, more economic instability. SVB Bank and 2 other banks failed because they didn't mitigate the risk in their treasury portfolios. They held treasuries that yielded 1 or 2%, and when yields went to 4 and 5%, their bond portfolios collapsed in value. They didn't have enough collateral and they failed. So now we've got economic instability, and gold is punching all the way back up to 2055 again, a triple top. So these are the different kind of forces that can push gold up and down in value. And then we got more geopolitical instability. Just as gold was leaking in the fall of 2023, Hamas attacked Israel. And now gold is not only hitting 2055, it's testing 2100. And it's trying to break out after a 3-year hard top at 2050. But there's something more material boiling under the surface. The de-dollarization movement that occurred once Russia invaded the Ukraine and we sanctioned Russia, freezing their assets, throwing them off of the SWIFT international bank transfer payment system. Now, some of these global South BRICS countries, they want to get out of the dollar, but they can't because the dollar is embedded in the world's financial system. There is no viable alternative to the dollar except for gold. Central bankers, the most conservative bankers on the planet, became record buyers of gold in 2022 and 2023 and 2024. And that's indicated on the chart now. And you can see that rising arrow when this trend really started to ramp up, show a higher low every time gold dipped. It was a higher low than the previous one, which led to the breakout. And as we got into last summer, about this time last year, gold was bumping up against 2,500. 2 wars, debt just keeps growing, record central bank gold demand. That's helped to break gold out and now has added a new major driver to the gold price internationally. And let me explain this to you, because this is really where it's become most material. When World War II ended, central banks around the world had gold reserves. Those gold coins that were currency prior to World War II all got cold in the late 30s because the gold price was raised from $20 an ounce to $35 an ounce internationally between 1933 and 1935, which made all those coins obsolete at face value and worth now 75% more in gold value. So central bankers took in all these gold coins that were their currencies for their countries and held them in reserves. Once World War II ended and we made the dollar the world's reserve currency backed by gold, central bankers decided they didn't need to hold these gold holdings. So for most of the time between 1950 and 2010, excluding a period in the 70s and early 80s, central bankers were net sellers of gold. But once the great financial crisis occurred and we had a global debt explosion, central bankers started to buy gold again in earnest, on average about 500 tons a year from 2011 into 2022. The mines produce about 3,500 tons of gold a year on average. So now their central bankers are taking off about a seventh of annual mine production. But once Russia invaded the Ukraine and other countries around the world realized if we could do it to Russia, we could do it to them with the dollar weaponization, central bankers started to double their gold buying. In 2022, 2023, and 2024, over 1,000 tons a year. So now they're buying a quarter to a third of the annual mining production and soaking up a lot of the excess gold that's around the world in the markets. Now, this is not a US-centric phenomenon. This is a global phenomenon, which is why most people in America don't get it. For 2025, they're on pace to do about 800 tons of gold right now, the way the numbers are shaping up. So they're buying still at near record rates. And that leads us into 2025. Central banks continue to diversify into gold, not quite at record rates, but close. We've got tariff turmoil driving economic uncertainty. And this is a revised chart that shows you the gains through middle of July. You can see leading into October of 2024, gold ramped up on presidential election uncertainty when Joe Biden dropped out and Kamala Harris stepped in. Trump was elected right at that top at 27.85, and then gold settled down a bit. But then when the Trump administration took power in January and the announcement of tariffs started to come, that we're going to tariff people, and then tariff turmoil hit, well, gold took off again. And something else happened that was major in April. Gold replaced and stepped in front of US Treasuries and the dollar internationally as the first safe haven of choice, which is something I've never seen before in my 45 years being in these markets. So there's gold, first choice safe haven, ahead of US Treasuries and the dollar, and I'll explain that in just a minute. And gold running all the way up to 34.34 on a New York close at the high so far. But what happened during April was on April 2nd, President Trump announced the reciprocal tariffs that were much greater than anyone thought they might be. And at that point in time, the yield on a 10-year Treasury was 4% and declining. Just a week later, that yield had spiked to 4.5% on April 9th. This is turmoil in the world's biggest credit market, the US bond market, with investors dumping treasuries, pushing them down, the value of them down, and the yields higher. This is why President Trump rescinded reciprocal tariffs on April 9th. It's because Scott Bessent walked into the Oval Office and said, President Trump, if you do not do something about the flight out of US Treasuries that's occurring and the yields that are spiking in the biggest credit market in the world, we're going to have much bigger problems on our hand. So President Trump rescinded the reciprocal tariffs for 90 days until July 7th or 8th. And that brought stability back into the bond market. But something else happened that's actually material as well. And this dovetails with the yield spiking. When President Trump took the reciprocal tariffs off of every country, he ratcheted them up on China from 54% on April 2nd to 145% on April 10th. He really put the heat on China because they were reciprocating by raising tariffs on us. That's the tit for tat tariff increases. And the Chinese went on a gold buying spree like we've never seen before, driving the gold price from 29.50 all the way to 3,500 at the top intraday. If you're a Chinese investor, you have three places to invest your money. You can invest in stocks or you can invest in properties, both of which have done horribly in China since COVID, or you can invest in gold. And they clearly ran into gold. But this is a bigger phenomenon. Because of the shock of the reciprocal tariffs, we saw a lot of foreign money decide to leave the US. It's not just China running out and buying a lot of gold, it's foreign money exiting the US and going back home for better opportunity elsewhere. And that's led to a weaker dollar. Here's a US dollar index chart. When President Trump was elected, the dollar was about 103 on the US dollar index chart. It got almost all the way to 110 about the time that he was inaugurated. When Donald Trump and Volodymyr Zelensky had their blow up in the White House on February 28th, there was a palpable shift between the US supporting the Ukraine and the US not supporting the Ukraine so much, which meant that the governments of Europe, which had not been spending a lot of money on defense spending, would have to supplement that spending. And they did, which meant stimulus. They would now deficit spend to a greater degree, which, as we all know, is not a great way to stimulate, but it stimulates. That was a movement of foreign money out of the US and into Europe because of that. And the dollar took a big leg down. Then Liberation Day came, and the aftermath of that was another big leg down for the dollar. So now, unlike what happened in 2022, when the dollar was rising and gold was going down, now the dollar is falling and gold is going up. And between January and April, the dollar fell 12%, but gold gained 28% during that same time period. We saw a little puff up in the dollar, and now it's rolled over even further. And this weak dollar may continue. So there's the weaker dollar on the chart. So now we've got tariff turmoil that we didn't have before, gold stepping in front of treasuries as safe haven internationally, and a weaker dollar that are all helping to buoy gold now and push it even further. In fact, the New York Times even has it. The dollar's off to its worst start since 1973. And this is having other ramifications. Here's a 25-year US dollar index chart, which shows you back in 2020 and 2021, when we had a balanced budget for the first time in 20 years and the last time in 25 years, the dollar was as high as 121 on the index. When we got into the great financial crisis, it was in the lower third, under 88 and as low as 72. Once we got into some stability following the great financial crisis, the dollar moved into the middle trading range on the dollar index chart. And recently, it's been as high as 114. That is when the Fed raised rates. That's that interest rate tag. And we still have been high. The last tag over to the right at the high at 109, that's January of this year. And now the big drawdown. So the dollar's back into the middle of its three-tiered trading range over the last 25 years. And the Trump administration clearly wants a weaker dollar to favor exports if we can transition into a manufacturing economy. It'll make our exports easier to sell internationally. We'll see what happens, but the dollar has been real weak. It's finding some stability now, but the trend is your friend, and I wouldn't be surprised to see the dollar weaken further. And this brings us to the bond market. Jeffrey Gundlach, the bond king, says a reckoning is coming for U.S. debt now that we're at $37 trillion worth of debt. This is an article from Bloomberg in June, where he said specifically America's debt burden and interest expense have become untenable. There's an awareness now that the long-term treasury bond is not a legitimate flight to quality asset. A reckoning is coming. We have a tremendous paradigm shift where money is not coming into the United States and gold is suddenly the flight to quality asset. This is the bond king himself. And it's not just Goodluck, it's Mohammed Al-Arian, the former number 2 at PIMCO, who said the world is losing confidence in the sovereign side of the US. If you're looking for safe haven flows, you won't find them in the US Treasury market. This is a big deal. We have $18 trillion we need to refinance this year and next year. If you're a foreign investor and you're getting a 5% yield and the dollar drops 10%, by the time you take that money home, you've lost 5% when you convert it back into your home currency. That is a recipe for a disaster for continuing to finance US debt. We'll see how it goes. There's stability in the Treasury market now that wasn't in April and May, but this is a big deal. This is another article from Bloomberg. Bond investors are demanding more compensation to hold long-dated US debt due to growing anxiety about the widening fiscal deficit in the US. But more than that, we are now weaponizing tariffs. And you just saw it today, where we imposed a 50% tariff on India because they're continuing to buy oil from Russia, because we don't want Russian oil sold over the Ukrainian war. So Biden weaponized the dollar, and now Trump is weaponizing tariffs. This is a recipe for the global South, the BRICS nations, and others to continue buying gold. And it's not a good place for the US to be the bully in the world. So I see these as future price drivers. Central banks will continue to buy gold at record rates. Tariff weaponization is going to force trading partners, friends and foes alike, to find alternatives. Like China's trying to sell their goods in other markets now that they can't sell to us because of tariffs. Gold will remain first safe haven choice internationally. And this, again, it's not a US-centric gold market that's driven the price from 2,000 to 3,400. This is an international gold market. We don't have a gold culture in the United States because we've never had war on our shores and we've never had our currency fail. If you've lived elsewhere, and that's happened in the last 100 years, which it's happened in most places around the world, you have a gold culture. We don't. And now we're seeing some cracks in the US economy. We got a really weak jobs report 2 weeks ago. And the ISM Services Manufacturing Survey came out just 2 days ago. And services, which have created a lot of the jobs in addition to healthcare in the last couple of years, are faltering. So we could get higher unemployment. And we're seeing 3 Fed governors talking about employment starting to be a concern, which means we're going to get lower interest rates. If we go into a real recession, which could happen, we're going to see our debt surge even further. We'll take in less taxes despite bringing in money for tariffs, which leads to further dollar weakness, which helps to buoy gold, and ultimately could create a bigger problem with the US debt refinancing unless interest rates are commensurate with risk. I'm friends with Rick Rule, who's one of the great natural resource investors and analysts. He says pretty simply, with $37 trillion of debt on the books and probably about another $110 trillion off the books, would you bet on the US for 10 years for 4.5%? Probably not. So that's gold. Let's talk a little bit about silver. This is a 1-year silver chart. Silver has been trying to move higher. It's more volatile than gold. It's lagging gold in appreciation. I call this a 1 step forward, 2 steps forward, 1 step back market, where it makes some big moves and keeps trending higher, but then it takes a correction. but now silver is getting closer and closer to a major breakout. If you look at a 22-year chart, this shows you the big run silver had during the great financial crisis and where we are today. In 1980, silver was $50 an ounce. During the great financial crisis, it was $48.60 an ounce. Today, it's about $38 an ounce. Silver tends to play catch up to gold in the later stages of a gold bull market, which we seem to be getting closer to. If this was a baseball game and it's 9 innings, I would say we're probably in inning 6 or 7. And the last time silver ran, it ran in innings 7 and 8. And I think we're getting close to silver making potentially a much bigger move. And I think the formation that we have off to the right in that bigger blue ellipse is potentially more powerful than the one we saw in 2008 to 2010 when silver ran from 20 to 48. I actually think silver could get to 60 or $70. In the short term, I'm looking for $45 an ounce and then a break over 50, the previous high. But that'll attract a lot of momentum. So I really like silver, which is still about 20% less than its 2 previous highs, while gold is now 75% over its previous highs at 2050. I've got a YouTube channel if you all want to follow me. I give updates like this every week or 2 or 3. I'd love to have you subscribers. And if anyone's interested in getting started with physical precious metals, there's a QR code that leads to our website. All we need really is your name and email address to put you on our email list if you'd like. And we'll send you our Getting Started guide, which is a very 101 primer on the most basic way to own precious metals. And that is my presentation, George.
Amazing. I love it. I love the charts. I love the macro breakdown, the history, the recent history over the last century or two, and then all those factors that just pull in different directions on the demand for precious metals and particularly gold. So thank you for that. We do have a question in the Q&A, and I also have some questions. Please, if you guys have questions, you can leave them in the Q&A, and I'll make sure I get to all of them. First question is, a lot of this discussion was about gold. How much of this applies to other metals such as silver? I guess I can follow that up with, do you think the same factors that you pointed out also are implicated in the price of silver? And then I think it's also important to comment on the suppression of the price of silver versus gold. What's your take on that, Dana?
All right, so a couple things. Number one, gold has been leading, and silver, platinum, and palladium have been lagging. Now, gold is about a 90% monetary metal and about a 10% commodity metal, while silver, platinum, and palladium are probably 60% commodity, 70% commodity, and 30 or 40% traditionally monetary. Especially silver has a bit more monetary value, of course. We've never had really platinum or palladium coins. So if the economy of the world, which has been weak since COVID, that's going to create less demand for silver, platinum, and palladium. But we saw something interesting happen when gold spiked in April and it ran from 3,000 to 3,500. And then President Trump says, you know what, on China, those 145% tariffs, we can ease that a bit. And let's talk about it because it was starting to make people crazy. Gold settled back down. There were, I think, some big investors in the precious metals arena who were in gold at that point in time. And they said, you know what, there's more opportunity now because gold has made such a big run in silver and platinum and palladium. And we've seen a rotation since then into those metals, with silver going from about $33, $34 an ounce to a high of 39 so far. Platinum was under 1,075 and it's run up to as high as 1,400. It's cheaper now. It's about 1,300. And palladium has even played some catch up too, from about 950 to as high as about 1,300, and it's about 1150 today, if I remember correctly. So the other metals are starting to play catch up, but gold is clearly leading. It is the monetary metal. It's the easiest to do big settlements in this. So the BRICS countries and the other countries that want to get out of the dollar, they're doing more trading in their own currencies against each other now. So if Brazil and China, say China sells Brazil 100 billion of products and Brazil sells China 90 billion worth of products, they're not going to change 100 billion in hands. They're going to change the 10 billion that's the difference. And some of those transactions are starting to actually be settled in gold instead of dollars or instead of currency. So that's where gold comes in. But you're never going to see that with silver in particular or platinum and palladium. But silver is in a structural physical supply deficit, which means there is more above ground demand for silver than is coming out of the mines on an annual basis. It's been this way for the last 5 years. It's starting to get meaningful. So what it means is we're eating into the above ground supply of silver more and more. There are not primary mines for silver like there are for gold. Silver tends to be a byproduct of mining other metals. So resupplying silver will be more problematic if demand ramps up. And I've got to tell you, the US weapons stockpile is getting woefully low because we've given a lot of our munitions to the Ukraine and we haven't replaced them. And silver is used in some of those munitions pretty heavily. I think Robert Kiyosaki, who I'm friends with, has told me that every time they fire off a cruise missile, there goes about 30 pounds of silver. So I do think the other metals will play catch up, but gold is clearly leading. I think the better opportunities in silver second. Platinum and palladium are mostly used in catalytic converters for diesel and gasoline engines. Platinum for diesel and palladium for gasoline. That's how I see the other metals. I do see silver having an opportunity to really play catch up. I see there's another question. I thought the BRICS countries were trying to use mainstream crypto use. Clearly, Bitcoin is an alternative currency today. There will be, I think, stable coins, which is basically just a digital version of the dollar. China has a stable coin that for the yuan, I believe. I'm not a crypto expert. I'm a humble precious metals dealer and a macro geek. So I don't know the best answer regarding crypto. What the BRICS countries are trying to do is set up an alternative payment transfer system to the SWIFT dollar system. And they're working on that diligently, whether that involves a bank transfer system like SWIFT or it's strictly digital. It'll probably be more digital, but I don't know the ramifications for that myself.
Yeah, I think they're getting ready for some kind of pivot. And so that's typically going to include gold. I think on one of your last slides, that first point of the fact that central banks are buying gold is one of the biggest, most important factors in this gold story right now. Like these central banks are essentially central planners, particularly for our money supply, right? Or in
Mm-hmm.
countries around the world. And I think it says a lot that these central banks are buying gold at record paces, number one. And number two, they're probably underreporting how much they're buying, including the US. And so
Well, we hope.
what does that really say about what's coming? It's these are the institutions that are controlling the actual fiat money supply, and they're buying gold at record pace. I think that says a lot, right?
Yeah, they're the most conservative bankers on the planet. I think they shifted towards gold once the debt explosion occurred because they're ones that control the printing presses. And they
Right.
knew what they were doing in diluting the value. And I think they were buying a hedge against counterparty risk, which is other governments defaulting on them if they're loaning money or have trade imbalances. But since the weaponization of the dollar, they've really stepped up to try and find a way out of being so dependent on the dollar in the US, just in case they run politically afoul of us, just like India has just done by buying
Yeah.
Russian oil. China, too.
Yeah. So I do think they're just getting ready for a pivot. And gold is probably one asset you want to make sure you have if there's a pivot. Who knows what the monetary system is going to look like in the next 10, 20, 30 years. It may
Right.
be based on a cryptocurrency or gold-backed cryptocurrency or another paper fiat currency. But when the pivot happens, you want to be in gold because it's tried and true. Because then you
Well,
can
that's,
go any way from there.
yeah, I especially gold. It did very well during the great financial crisis when real estate did not. And in 2007, bankers would loan money to dead people. And in 2011, bankers wouldn't give Bill Gates loans. They wouldn't give money to the most credible people in the world who are good risks. So if you're a real estate investor, and I know that's probably some of your people, and you have some gold, and pardon me, the shit hits the fan, you have liquidity and you have the ability to raise some funds quickly if you need to, because gold is immediately liquid. When you may not be able to get a loan, if you want to take advantage of distressed asset sales, which could happen. Now, that worked perfectly between 2008 and 2010, 11. We haven't seen that since, but it's a good strategy if you want to have an insurance policy and then you want to pivot into something that else if gold becomes too valuable and other things are less valuable.
I wanted to go back to the silver story here just to touch on the suppression of the price of silver and maybe even the suppression of the price of gold. Is that breaking? Could you first explain that and then the outlook of that? Because there's rumblings now that suppression system, that mechanism is breaking down, and therefore there may be a huge breakout. That might be one of those factors that allow for a big breakout for the price of silver.
Yeah, I do not believe in my gut that the metals are actually fully manipulated and held in check. I was told gold was being manipulated when it was $300 an ounce in 2002, and it got manipulated all the way up to 1900 in 2011. I do think the metals get bullied by the paper market, the COMEX exchange, where you can trade 100 times the amount of physical gold on paper in paper contracts at the click of a button. I do think the metals get bullied, but I believe that's more short term than long term. Now, we are seeing a huge fear of tariffs on precious metals over the last 6 months pull record amounts of physical metal into the New York's COMEX warehouses, both for gold and for silver, pulling metal out of London, where it's typically been housed as a vaulting area, because most of the physical markets are in London, while the paper markets are in New York. And this has been a premium. If you had the metal in New York, you could get a premium over what you could get for the same ounces in London on an arbitrage. And the big bullion banks have taken advantage of it and brought more than double the amount of silver into the COMEX warehouses from under 200 million ounces to almost 500 million ounces today. And in gold, we've seen go from 20 million ounces to 45 million ounces in COMEX warehouses. The same thing happened during COVID, but that's because we had record physical demand for metals following the COVID outbreak. Americans bought gold and silver like crazy, and we needed that metal. So there's some conspiracy thinking that perhaps the US is reshoring metal on purpose to buoy our stockpiles. And this could lead to a physical silver shortage because silver, in particular, is becoming very tight in London. It's not warehoused by central banks like gold is. Silver is a commodity. There has been delays in getting metal out of vaults in London just because they've been overrun due to this tariff premium. But as soon as the tariffs on precious metals did not materialize following the announcement of the reciprocal tariffs, we saw gold started to go out of the COMEX warehouses down to about 37 million ounces from 45 million. So that started to draw down. Silver has stayed up. And I think the primary reason for that is because most of the silver that we get out of Canada and Mexico. And there's been a lot of tariff uncertainty over, are we going to tariff them at 30% or 35%? Or are we going to go back to the NAFTA agreement and Many things are excluded. Precious metals in particular are not so far at all on the tariff list, but different countries that we deal with could have tariffs that could be affect precious metals. So I think that's cause some strain. Now, whether there's an underlying motive under that, I don't know. And I don't know if anybody knows other than President Trump and a couple of key advisors. For anyone to think they know past them what might actually happen, I don't buy it. But the metals, the futures markets do bully the metals. JP Morgan Chase got convicted of manipulating the gold market, but what they were really doing was front running client trades for pennies, nickels, and dollars in their own pocket against orders their clients were trying to place. That is a manipulation, but that's a short term manipulation for minutes at a time. It's not a long term manipulation to hold the price in check. I've always seen gold and silver go where I think they've eventually needed to go, despite being bullied, pushed around a bit, because they're smaller markets and they can be bullied.
Gotcha.
My 2 cents anyway.
Gotcha. Love it. I wanted to talk about the nature of gold, like you said in the beginning, being just a rock, right? And just sitting there. And it's great for protecting purchasing power, hedge against inflation. But might there be some ways to realize or mobilize the equity that you're building in the actual gold itself, just through strategic investing? I wanted to just see what you thought about the different ways to monetize that pet rock, so to speak.
You do tie up a lot of funds that are not otherwise available. Now, there are a couple of companies in the country that will loan you against your precious metals holding. There's a company called TDS Vaults, Trans Depository Service Vaults, that has an independent storage facility on the airport grounds of the Las Vegas airport, Harry Reid International Airport, where they run their own fulfillment center for one of the US Mint distributors. That's where their fulfillment center is, and they have a side business, which is a storage business. So you and I could store our metal at TDS Vaults in Las Vegas in a segregated account, which means our metal lives by itself on a shelf. Now, if you want to borrow against that, they'll also loan money against your holdings, and you can get the money in a couple of days by just simply pledging the metal against the loan. And they'll give you 75% loan to value. But the interest rate's going to be higher. It's prime plus a couple points. It's not a very competitive rate. And you could be subject to a margin call if the value of your loan falls because the gold value or the asset falls. So there's some hair on that, but that's one way to harness some money that you have if you can arbitrage the interest rate that you're paying to get a higher interest rate somewhere else. But that's one way you
I
can
would,
unlock the equity.
I would
Yeah.
add some more plus minuses. It's tax free, so that loan that you get, I almost make the analogy to whole life insurance. It's an asset that you can borrow against tax free and go find another asset that pays you higher than the interest rate on the loan to potentially mobilize that equity. But it does introduce some counterparty risk, right?
Yeah,
Would you?
this particular entity does, I think, is reliable. They're responsible. I don't think you really have true counterparty risk. Now, there's another company out there that's come up in the last couple of years that will pay you an interest on your gold holdings. You can earn 4% a year on your gold, but you surrender your gold to them. And to me, that offers 100% risk for a 4% return. And it does appeal to real estate people who are just want to yield, but that's not why you have physical gold. You
Right.
have physical gold so you have money outside of the system in case something happens. You have transportable, portable, liquid wealth. For silver, if you want to have spending money in a crisis, that's really what an ounce of silver is much better at. 100 ounces of gold is about the size of a paperback novel, weighs about 8 pounds, and you could fit one of those 100-ounce bars in each of your suit pockets and be walking around with 700 grand in cash in your pockets, and no one would know it. Now, the only thing close to that is Bitcoin and a really great watch.
What about renting out your gold? That's something I've learned about this year. Housing it in, like you said, in a vault, but that gold actually can theoretically get rented out and you get paid rent. So it's like an apartment building in essence, right?
Yeah, but an apartment's not going to walk off on you.
The
To me, it
tenant might,
defeats, yeah.
the tenant might walk off on you, but
Yeah. To me, it defeats the purpose of having precious metals in the first place. And I think it just way too much risk for the reward that you're going to get. It just rubs me the wrong way. I don't like it. And that's me
yeah,
personally.
I agree. I think there's plus minuses to everything. If there are folks who wanted to use creative ways to get like a yield, but then you're trading, it's a trade-off. There's no free lunch, right? Now you're trading off like some counterparty risk at this point because you're literally lending it out to a jeweler or something.
I've seen three or four spectacular failures in my career over 45 years. In the 80s, there was a vault that was supposed to have gold bars in it. When they realized that the company was failing, they went in the vault and they found wooden bars painted to look like gold. There was a
Yeah.
big company in Austin, Texas in 2014 that was using client purchases and to broker sales, and they were being the intermediary. They weren't supposed to have any inventory. They didn't have any of the client gold they were supposed to have.
Yeah.
It just, I've seen too many failures. It's too nefarious. And there was a big storage facility actually in Delaware that recently failed because the owner of the storage facility was a thief. So it's really pays to know who you're doing business with and what kind of a track record they have. You don't want to do anything, you don't want to buy precious metals on the online auction platforms. They're riddled with counterfeit merchandise, spurious merchandise from China. You want to do business with people in my sphere, the precious metal sphere, regardless of what it is, with the older people that have been around a long time. We have the experience and the knowledge, and there's enough choices out there for everyone to find someone who's been around a long time that has a good track record. It matters. It matters.
No, 100%. And to that point, talking about just some of the risk out there, I think it's also important to talk about some of the risks of self-purchasing and self-custody. There's a cost, right? There is a cost that comes to purchasing gold and holding gold and, storing it and keeping it safe. Could you talk a little bit about that? Because I don't think a lot of people, at least I didn't really understand that until I looked deeper into it. But it's not just the spot price that you're paying for. And if you're self custodying, there's also single point risk failure. You can get robbed. Could you speak on some of those plus minuses, self custody, self purchasing, cost of holding?
Physical precious metals like ounces that the US Mint makes or the Canadian Mint make or bars that a Swiss refinery makes are not competitively priced on a buy sell spread like a stock where you have a half a point spread. We tend to have 3 to 4 percentage points of buy sell difference. So if you buy an ounce of gold for me and the price doesn't change and you want to sell it right back to me, that margin is 3 to 4%. And today that equals $90 to $120 an ounce. How much that gold has to go up just for you to break even. With silver, it's about $2 an ounce. That's because there's a manufacturing fee, there's insurance, there's shipping, there's a profit. I make 1 to 2% on ounces of gold and $1 if I'm lucky to $1.50 an ounce on silver when I buy it from the market and sell it to the public. And the buy sell spread to the public is a little wider than that, the net buy sell. So there's friction to the transaction. You don't want to put money into physical precious metals that you want to get back quickly. This is a longer term hold. So it's like a savings account, number one. Number two, where are you going to store it? You want to store it someplace safe that you have 24-hour access to it. You want to be able to get it if you need it. We used to use safe deposit boxes. We don't recommend that anymore because what if there's a bank holiday and you can't get in there? And some banks are writing precious metals or coins out of their charter because they don't like the fact that people that have that stuff go in and out of the safe deposit box areas more frequently. It's more service for them. So you have to store it someplace safe. Now, gold, as I said, is compact. It's easy to hide it someplace in your house. If you have a problem, say you have a house fire, your gold will still probably be there. It just might not be in the same form that it was when the fire started. You'll have a blob instead of coins or bars or whatever you had to start with. And I've seen that happen on many occasions, silver too. But you do take on a risk when you have it home stored. There are private storage facilities that we can recommend that are run by independent companies that are professionals in the industry, like TDS is a professional warehouse service. Brinks is another. There's a vault in Delaware, Delaware Depository Services. That is a good one that a lot of IRA companies use to store precious metals if you're putting precious metals into your IRA. You can do that, but you have to use a custodian. You can't hold the metal yourself. You have to do this through a custodian. So that means you set up an account with the custodian, you put the money in the account, you name your precious metals dealer so the custodian will talk to you about your account. We do a transaction between ourselves. Then we tell the custodian what we did, and the custodian pays my company as the dealer, and we ship to the custodian's vault to hold the metal. So you never see the metal yourself. That's how traditional IRAs can hold precious metals. If you have a self-directed IRA, you've got to be careful because there has been a case with the IRS where people actually held the metal themselves and the government ruled that they took a distribution. That money that the metals investment amounted to was actually a distribution. So they got penalized and tagged for that. So you got to be careful. There are risks involved. Silver is especially problematic because it takes up a lot of room. We had a client that bought, when the Mint sells us silver eagles or the Canadian Mint sells us silver maple leafs, we get them in 500 coin boxes. They're like boot boxes. They weigh about 40 pounds each. We sold the client 50,000 ounces of silver, 100 of those boxes, 500 ounces each. He lived in a condominium in downtown Philadelphia. Guess what? He wasn't going to store those in his condo in Philadelphia. So we set him up with a storage account at TDS in Las Vegas, where the metal stayed. He paid 0.5% of value a year as a storage fee, which is mostly insurance because the metal is just sitting there, but the value goes up and down. And if the place ever does get robbed, they have to have the right insurance coverage. So they charge you on a value basis, not on an ounce basis. So your storage fees can go up or down depending on whether the metal prices are going up or down. Now, when he wanted to sell, it was easy because he just called up TDS and filled out the paperwork and sold it to us. And we actually took the metal at TDS. We got what we call a shelf swap. So he never had to handle this 140-pound boxes of silver himself. You need a younger, strong guy like you, George, to haul that stuff around, not me. I can't do that anymore.
I know too
So
much. I'm an orthopedic surgeon.
yeah, you fix the problems that causes.
Yes,
Yeah.
pretty much.
So there is a wheelbarrow and a mule component to silver that doesn't exist with gold. So you have to think about that if you're going to own a lot of silver because it takes up a lot more room proportionally.
Yep, makes sense. All right, we're 6 minutes past the hour. There was another question, but I think we may have answered it. Is there a way to borrow against physical gold similar to borrowing against other assets, or do you have to sell it to get currency?
Like I said, you can borrow against your metal there. And there's a new bank that's coming up right now that Rick Rule, who is that mining stock analyst, is created. It's called Battle Bank. Now
Yeah.
he's going to loan against precious metals holdings, and he'll do it inside the TDS spreads because he knows their market and he knows he can beat them for competitive interest rates and service. That's another alternative to consider. And you were about to ask, I'm sorry, before I cut you off.
What are the tax implications of how is it taxed when you sell it? Sell it for a profit out of it.
Yeah, capital gains, 28%.
Yeah.
Right now, we don't have 1099B reporting requirements like you get with every single stock that you sell. Most precious metal sales don't require the dealer to generate a 1099B. So it's up to you to do your own reporting. But we don't have to trigger that with a 1099B. The other thing about precious metals is if you own precious metals and you pass away, your heirs get a stepped up cost basis at the time of your death. And I've seen that happen many times where, a gentleman who's in his 50s or 60s has accumulated gold into his 70s or early 80s. Then he passes away and his heirs get the metal. And we've seen some big gains, and the estates are not responsible for any taxes on that gain. Unfortunately, some people are not trained properly by the original buyer, and as soon as the heirs get their hands on the metal, they want to sell it. That happens a lot too. So if you're interested in any asset, you got to teach your kids why you have it. because there's a reason you bought it in the first place, especially longer term holds, which precious metals should be. Like I said, they're like an insurance policy. 10% of assets as an insurance policy that you hope you never need to touch is really good. But if you need it, you're going to want it when things are usually way upside down.
Thank you, Dana. This has been a great webinar and an education on the precious metals markets and the macro. Honestly, that's, like I said, it's more fascinating and interesting than TV. And I think you laid it out just like that. So I want to thank
Most
you
people don't
again.
understand what drives the market. So that's why I try and explain it. And the fundamentals that are driving these things, they're in place. They're not backing down anytime soon. I think there's more to go here. And I wish we had a better gold culture in our country. So thank you for letting me have the time with your people and sharing. And I really appreciate what you're doing, George, and really appreciate our friendship. So thank you so much.
For sure. 100%. Thank you, Dana. Thank you, everybody. And we'll see you on the next one. Everyone have a good night.